capital structure, historical stock, and operating performance.
Hovakimian, and Tehranian examined the relationship between market and operating performance and the external financing decision by focusing on firms that issued both equity and debt. 9 Their study supported hypotheses that firms with high market-to-book values have low leverage ratios and that high stock returns are related to equity issuance. However, they did not find evidence that market performance has a bearing on debt issuance. Furthermore, the study found no relationship between operating performance and target capital structure but did find a relationship between profitability and a firm's response to deviations from target capital structure. As losses accumulated, unprofitable firms experienced a decrease in the value of equity, which caused debt ratios to rise above their targets. These firms tended to issue equity to correct these deviations from target levels of leverage. In contrast, profitable firms experienced an increase in equity as profits accumulated, causing their debt ratios to fall below target values. However, these firms did not issue more debt to correct the deviation. Under these circumstances, firms behaved consistently with pecking-order theory, whereby they used accumulated profits as a source of internal funding rather than issuing more debt. In summary, firms tend to have a target capital structure, but the preference for internal financing and the appeal of market timing tend to distract them from maintaining these target structures. Welch explored the relationship between historical stock prices and capital structure. 10 Sometimes referred to as inertia theory, Welch hypothesized that firms behave as though they have a target capital structure but are slow to act to reverse diversions from the target. In an analysis of all publicly traded firms between 1962 and 2000, the study found evidence that firms had target debt ratios. In particular, a firm's capital structure was highly correlated to the capital structure in the prior year. Testing the hypothesis over a 5-year period, the research found that correlation effects were long-standing, providing further evidence that firms had target debt ratios. However, as stock prices caused a firm's capital structure to move away from its target, firms did not counteract this divergence despite frequent debt and equity issuing activity. Welch found that 60% of capital structure was explained by such issuing activity but that this activity was not intended to readjust capital structure when debt ratios changed. In fact, over the long term, 40% of firms' capital structure was determined by debt ratio changes resulting from stock price movements, and these changes did not seem to be followed by management actions to readjust capital structure. Flannery and Rangan studied the capital structure trends of non-financial firms between 1966 and 2001.11. Although conceding that there are many factors that influence a firm's capital structure, for example, historical stock prices, pecking orders, and market timing tendencies, they disagreed with Welch's assertion that firms do not readily take action to reverse divergences from the target capital structures due to stock price movements. They suggested that pecking order and market timing theories tend to explain about 10% of capital structure changes and restructuring toward target levels of leverage explained more than half. When capital structure moves away from the target, firms take actions to move the capital structure back toward the target structure at a rate of more than 30% per year, 3 times more than what other research suggests.